Let's move on to fees now. Obviously, this is one of the very important parts of portfolio management is the fees. It's also very important to the investment public. Should I invest in a fund that has no fees or no loads? Should I invest in one that has front fees, front loads? Should I invest in one with back fees, back end? What are the fees on an ongoing basis? Is an unmanaged fund less expensive than a managed fund? Does this result in higher rates of return? These are all questions that the investment public is asking, and the investment industry tries to quantify. So let's take a look at fees for a moment. Unmanaged versus managed. Unmanaged, you have a one-time fee. So we have a one-time fee here. How is this fee calculated? Well, typically in an unmanaged fund, the net asset value charged to the initial investors is higher than the underlying net asset value. So the difference between the two net asset values is the fee. And that really is the only fee for an unmanaged fund. The reason it's called unmanaged, of course, is it's never turned, no one actually manages it on a day-to-day basis. The investments are put in place and left and for the life of the investment, so you just have one fee. And that's it. Very cheap, but also then you don't have the benefits of a managed fund. Managed fund, as the word implies, you have a day-to-day manager. They're buying and selling and changing the portfolio strategies. They're trying to determine movements in the market and therefore trying to benefit the investor with a higher rate of return for hopefully a lower level of risk. However, of course, with a managed fund, you get fees, what I call front, middle, and back. Basically, they stick it to you any way they can. Front fees, i.e. load, you can buy in, and there's some fees right up front to purchase, i.e. you invest, let's call it over here, we invest $100. They charge you 1%. So what you'll see showing up in your first account is not a $100 investment. They'll take their 1% fee off that, and ultimately you will only have invested $99. Now, the fund, of course, has to return more than the 1% to get you back and beyond your initial investment, but that's a front fee. During the life of your investment, your $99, you're going to have some middle fees. So in other words, there's going to be ongoing management fees. Those might be 1% on an ongoing basis. They might be 0.25%. They might be, in the hedge fund industry, 1% plus 20% of the upside, which we'll get into a little bit later. But for right now, typically these management fees are set in stone. They're relatively low for the life of the fund. And then in case you decide not to buy a fund that has the front fee, you'd rather have your $100 invested and grow, and then at the end of the life of your investment, when you decide to redeem your funds, your shares, then you'll get charged a fee at the end, or a back-end fee. These fees typically can be reduced. The fees that can be charged at the end, the back fees, they can be reduced over time. So in other words, if you had invested your $100 and you redeem it the next day, the percentage charged on that fee might be, let's say, 6%. However, if you were to hold that investment for 3 to 5 years, the redemption fees on that typically get reduced. Obviously, the reason for that is the middle fees, they're making it up in the middle. Believe you me, this is like the IRS, they'll get their fees somehow. But we have to determine whether the investment's going to benefit from a front fee, a back fee, or the middle fees are always in place, and there are funds with no loads. Does a no load benefit the investor because of the no fees involved? I don't think there's any empirical evidence of that. However, fees is a very important issue to look into and to try to determine the impact of your portfolio investment. Let's go into the types of investment companies that are available. Obviously, once again, we're back to the investment industry. We've always got to understand that alternative investments are offered to the general public. So whatever they demand, we will offer. When there's a high level of demand, the investment vehicle will stay around for the eternity. When there's a low level of demand, you'll see different alternative investments come and go over time. However, let's look for a moment at the different styles and different types of investments that are out there so that we can get an understanding of what at present is available. The first type of investment company, or the first thing to look at, there's different styles within each investment type. What do we mean by style? You've got growth funds, you've got value funds, you've got small cap, you've got large cap, and then, of course, within that, you've got large cap growth, large cap value, small cap growth, small cap value, but those are all different styles. So under the styles, you've got to remember, are we investing just in large funds, are we investing in small funds, and are we investing in value funds, or is it a growth style of investment? Sector. The different sectors that are available, we all know there's the tech, there's biotech, there's industrials. Which sector or which industry are we investing in? Then you get your typical index funds. They're tied to an index like the S&P 500, the Dow Jones, the NASDAQ 100. These are just linked to an index. So therefore, in a way, they have some kind of a sector influence and some kind of style influence, because if you're looking at the Dow Jones, of course, as an index, your style would be a large cap, and you would be, the sector would really fall away because it's supposed to be a diverse sector of 30 stocks, but you would obviously be in an index. A global fund, that obviously, as the word implies, is international. You're investing in the FTSE, you're investing in the Nikkei, you're investing in the CAC and all the other different indexes that are around, and you're blending that into one global investment portfolio. And then you've got stable value, which really, you're looking at money markets, bonds, specifically you're looking at treasuries, gilts in the UK, etc. So these, you've got to remember, you have 5 different investment types. You've got style, sector, index, global, and stable value. The newest investment offering in recent times, or one of the most successful ever actually, is the exchange-traded funds, the ETFs. These ETFs have been hugely popular for a number of reasons. We have diversification reasons. We have the fact that they're liquid. They offer the investment public a huge array of different alternative investments and a cheap and easy way to diversify your investments into international, global, fixed income, and various other types of investments right away. They trade daily. They trade like funds. It just goes on and on and on. There's so many benefits to these types of investments that it's almost too numerous to mention. And this has been one of the big success stories of recent years. Let's start by looking at some of the characteristics of ETFs. The first characteristic of exchange-traded funds is they trade like shares. I'm sure you're all aware of a number of these ETFs. You have the Qs, the QQQ symbol that trades on the NASDAQ stock exchange. There's the diamonds, the DIAs, that track the Dow Jones Industrial Average. And you've got the spiders, which track the S&P 500. Those are probably the most frequently cited of the ETFs. There's certain ones that trade or track Japan, like the Nikkei. There's others that track the CAC, or the French index, and the FTSE, or the Financial Times, the UK index. So these are exchange-traded funds. They're trading back and forth shares on the market. I'm not exactly certain what the Qs trade every day, but it's definitely upward of 20 million shares in a day. So very actively traded, very tight margins, and very liquid, and something that you can really easily, as a portfolio manager, buy into. So you have your investment strategy. You determine that you've got your underlying stocks. You could use the Qs, for example, as a hedge to try and limit the downside of the overall portfolio. Or you can finish a strategy, completely go out there, buy the Qs rather than try and select individual stocks.